Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump and Mohammed bin Salman pledge $1 trillion in commercial deals between the US and Saudi Arabia. Defense, energy and tech all feature, but many details remain elusive. Tech stocks lead gains in Asia after soft US inflation helps propel the benchmark S&P back into positive territory for the year. Plus, more European earnings. Daimler Truck cuts its future guidance, while Hapag-Lloyd cites geopolitical challenges as clouding the outlook for shippers. We'll bring you Burberry numbers shortly.
In the meantime, a quick check on these macro markets. Equities seem to be in a little bit of a holding pattern when you look at this futures picture. Euro Stoxx 50 futures down by, we'll call it 0.1%. The S&P future story higher by about the same margin. But take a look at what the dollar is doing. Weaker this morning against the euro, down about trading at about 1.11 on that currency. But remember, keeping an eye on that treasury yield as well. Do they snap together? And gold, in the meantime, perhaps that's the biggest market move to keep an eye on this morning, down 0.5%. The countdown to the opening trade starts right now.
Apple is investing $500 billion. Nvidia is investing, and I see my friend is here, Jensen. That's very good, wherever you may be. Thank you very much, because he's putting in $500 billion. TSMC is investing $200 billion, and with this trip, we're adding over $1 trillion more in terms of investment.
A lot of smiles, a lot of really big numbers. And you do wonder whether or not these really big numbers are actually going to end up seeing the light of day. But at the moment, Anna, everybody's very happy.
Everybody's very smiley, and there was a lot of affection on both sides, it would seem, from this visit of President Trump to Saudi Arabia. That's where he started his Middle East journey. It goes to Qatar and other places, of course, we know from here. But in terms of the big number, let's start with that big number of $1 trillion. Other big numbers were already also available, it would seem. Some of the signage in the venue suggested actually $300 billion, and the White House later saying $600 billion. So anyway, we know defence is involved, gas turbines, chips, aircraft, healthcare. We know a lot of the sectors that are being mentioned, and no doubt some money will be changing hands here. So this is interesting in terms of the amount of money that's on the table, the deals being done for their own sake. But it's also interesting because of what it tells us about the transactional nature of this presidency and its priorities. This is no longer a US president going around the world spreading the values of democracy against autocracy. We've left that era behind us, it would seem, under this Trump presidency. He even goes so far as to say it is not our job to look into leaders' souls, to dispense justice against their sins. So he really setting the stage for a real change in policy from the United States. A different message emanating from the White House, for sure. This is all about foreign direct investment. I think it's interesting here, and I'm kind of waiting for the lines that go into Saudi in particular, or from Saudi in particular, because we've been here before. I'm getting a lot of deja vu from the conversation with SoftBank when he had promised something like $400 billion of investment from SoftBank. He did this in his first term as well, and that investment never came through. So I think the onus is really on them to show that these relationships that he has is going to show up. But it wasn't just the public companies. He had conversations with OpenAI as well, and plenty of startups that were in the room.
Yeah, the AI theme has been writ large throughout this entire conversation. There has, as you say, been many different sectors been involved in this, but the AI one seems to have been the star that has captured the kind of the top of the tree. Do we now see foreign policy as well in the Middle East through a Saudi lens? Through a GCC lens? Is that how we should now think about what happens in Israel, what happens in Iran as well? Because it does seem as if we are... You start with the transactional nature, then you frame foreign policy second as a result of that, and then you see where it ultimately takes you. And we got a big move in oil prices as a result of some of his comments on Iran, talking about the Saudi view of the world. So he was saying that, that Iran needed to limit its nuclear program, or its oil exports would be reduced to zero. That was the line coming out of the presidency yesterday, the US presidency, and oil prices went up by nearly 3% as a result of that, and some other factors. What does it tell the rest of the world about how to deal with Trump? Like, is it as simple as it starts with a dollar sign and you go from there? Because that seems to be the takeaway from this series of meetings. Royalty or very shiny lots of shiny things and dollar signs. Yeah. From the business perspective, he also removed sanctions on Syria, which, to your point, really speaks about where that geopolitical narrative is actually coming from. This is something that the Saudis and Turkey's President Erdogan had been lobbying the White House for some time. But actively, to your point,
not a ton being said about normalization with Israel, for example, which is a key touch point. Or, by the way, with oil prices, it certainly moved the market on Iran. But the U.S. is still competing for market share with the Saudis. So that's going to be something that's interesting. Let's talk about markets. We talked about oil there, but I'm more interested in the lack of market movement when it comes to the stock market and the bond market. Despite the fact that we got some CPI numbers yesterday, egg prices back to affordability.
Okay, I'm not doing Tom's jokes. Let's just be clear about that.
He's already done them. They were great first time.
Come on. Well, look, I'm trying... Okay, well done. Well done. Thank you for indulging me. I appreciate it. That's the one and done. But it's an important one here in terms of that we're talking about some of these gasoline prices coming down. We're talking about egg prices coming down. There are other places where things are coming down.
Sure.
Does that even matter, though, if tariffs are going to move everything else higher?
I was interested in, it was not eggs that caught my eye. It was, weirdly, audio equipment, because there we did see some read across from tariffs. They were up by more than 8%. And I had to remind myself, what this is actually turntables and headphones and that sort of stuff.
You remember those, don't you?
I remember those. But it all seemed rather retro, being about audio equipment. And so I was looking at what that includes. But this was a tariff effect. So because of the higher tariffs, we did see those prices going higher. But maybe that will be short-lived.
This was the number that everybody was going to be able to discount one way or the other.
Yeah,
I just park it, move on. It was too early for the tariff hit. Other things have come down. Gasoline prices have come down quite substantially. Park it, move on. I don't think this is the piece of data that is going to give us an accurate reflection of really what is happening inside the US economy right now. It ain't going to move the Fed in any big shape or form. Equities went up at the beginning of the week. They're struggling now. The dollar's kind of turned tail, which I think is interesting as well. And bond yields, particularly at the front end, have moved sharply higher to the point at which actually I do wonder whether they're going to be an impediment on the equity market. So equities still look fairly OK at the moment. But actually, other markets, significant markets, are telling a slightly more nuanced picture at the moment. Should we talk about equities? Burberry's out with numbers. Check. Let's talk a little bit about what we're seeing here. It could have been worse, seems to be the line that I'm reading out of all of this. So sales are down pretty sharply. The Chinese number is down pretty sharply. Sales minus 8%. The estimate was 9.5, though. The wholesale revenue decline by mid-teens is expected in the first half of 2026. Well, that's what they saw in 2026. The numbers are bad, but not as bad as the market was looking for. Every line just seems to have that story within it. Q4 retail comp sales minus 6, estimate 7.78, which seems oddly specific. But that is kind of the picture here. It could have been worse. I do wonder, therefore, how Burberry's going to react. The stocks has turned. Does today change the overall narrative? I'm not sure that it does.
Yeah, and away from the specifics of that business, we're obviously looking for clues as to how either the reality or the threat of tariffs has impacted on various businesses. And I know that we were digging for quite a long time to find the reference in the Hapag-Lloyd statement. It is there, but it's talking about major geopolitical challenges, volatile freight rates, the outlook being uncertain. And interesting, Bilfinger, who we'll be talking to a little bit later on, they say political factors had a noticeable impact on customers' investment behaviour in the first quarter. And so that speaks to the line of the damage being done in various different settings, but perhaps for corporate earnings, some damage has already been done, even if we've seen this reprieve on tariffs for 90 days.
Certainly the macro space, but I was going to say for Burberry specifically, and you had mentioned this, they're also talking about organizational changes that are affecting 1,700 roles globally.
Right.
Another organizational change for Burberry.
Yes. So the cost cutting continues. They're trying to figure out how to... They're basically resetting this business for a less optimistic environment. And they are doing that, A, through the kind of how they are set up operationally, but B, how the style is being reset as well. So two fairly major changes. How long does this process take to unfold, I think, is interesting. This is the Bilfinger statement and this is the Hapag-Lloyd statement that I've got this morning. And I've read through both of them. Hapag-Lloyd really quite specific in many areas. They go down through the sectors. They work out kind of what is happening, where they're seeing strength, where they're not seeing strength. Chemicals and petrochemicals, particularly challenging. Hapag-Lloyd is in the trade business, right? There's a line at the bottom of the highlights Q1 2025 about what is happening. It's 2 lines, not even 2 lines. It's a line and a half. You read through the rest of the statement, you'd barely believe there was trade war underway. So I am fascinated to talk to the CEO a little bit later on to get some more specifics about what is happening with this business.
With such levels of uncertainty and policy changing moments before probably this press statement went out.
Yeah.
What kind of visibility do you need? Yeah.
So has there been a change as a result of what we're seeing coming through from that China deal? Anyway, we're going to get some answers. Maybe. We'll see. Rolf Haben-Jansen is the Hapag-Lloyd CEO. He's going to be joining us fairly shortly, so we'll get his take. And we're going to be talking to Thomas Schulz, who is the Bilfinger CEO, which is going to be interesting as well. We'll get a take there. So Renault is relaunching the Renault 4. So, which was, if you remember this from history, it was a fantastic-looking car with an incredible gear change. But they obviously have updated that for the electric era. Apparently, they're going to be relaunching a van, maybe the Renault 4 van, iconic. Anyway, Fabrice Cambelive is the Renault brand CEO and is going to be joining us a little bit later on. My French teacher had one. They were amazing. Renault 4, loved them.
Icons. Prepare for nostalgia. There may be some later in the programme. We'll also be speaking, though, about markets. Becky Chin joins us, Fidelity Multi-Asset Portfolio Manager. Fabiana Fedeli, M&G CIO for Equities Multi-Asset and Sustainability, will be with us. So plenty of voices to chew over the latest in the earnings stories, Chrissy, and the multi-asset strategies as well.
Plenty of data sets as well to keep our eyes on. Of course, this all is perhaps shadowed by what's going on in the Middle East right now. Donald Trump, of course, visiting Qatar today, going from Saudi Arabia to there in his Middle East tour. But then you have a UK 10-year bond auction and a German 30-year bond auction as well. We'll see what kind of demand we see for the long end of that European debt. But I think perhaps, at least for me, the most important piece is going to be that OPEC monthly oil market report. Because since the last time we got that report, we saw a pretty completely 180 change in how OPEC is thinking about market share and production cuts and production hikes. So we're going to keep an eye on what that report has to yield.
What else do you need to know? What is it, Wednesday? This week is going very slowly. Wednesday morning. President Trump says Secretary of State Marco Rubio and other US officials will go to Istanbul later this week for potential talks between the leaders of Russia and Ukraine. This despite ongoing uncertainty as to whether President Vladimir Putin will actually show up. A senior White House official told Bloomberg that Trump envoys Steve Witkoff and Keith Kellogg will also attend. Microsoft is planning to axe around 6,000 jobs. The company says the cuts amount to less than 3% of total headcount, including LinkedIn. Around 2,000 workers will be impacted at Microsoft's headquarters in Washington state. The termination is expected to start from mid-July. And L'Oreal sold $1 billion of investment-grade notes yesterday, the company's first deal in the US corporate bond market, which is interesting. Bloomberg understands that the cosmetic firm 10-year note yields 0.625 percentage points above comparable treasuries.
Coming up on the programme, Donald Trump and Mohammed bin Salman are set to speak again later today. We will bring you the latest. Plus, as Burberry's fourth quarter sales fall by 6%, less than analysts had forecast, we'll check in on the British luxury firm at the market open. Up next, the S&P erases losses for the year and tech deals boost Asian markets. We will get back to the market story. If you have questions, if you want to be part of these conversations around this desk, IB plus BBTV Go. That's the function on the Bloomberg terminal. This is Bloomberg.
To see the U.S. Secretary of Treasury come to a meeting of the minds with the Chinese leadership was an important moment between our two nations. And I'd like to take this not as a moment in time or reflect upon the fragility of what's been accomplished, but rather to focus on the fact that we have opened the doors to a negotiation. And I do believe that the actions of both parties makes it clear that we want to find common ground.
Glass half full for Ken Griffin, the Citadel founder and CEO, speaking exclusively to Bloomberg, talking there about trade between China and the United States, and not what has been omitted, but what has been pledged already. Bloomberg's Valerie Teitel, of course, has spent the early part of this week digesting that news flow and CPI moves in the markets as a result. Valerie.
Yeah, we are all around bullishness in the U.S. equity market. And take a look at this chart behind me. The S&P 500 has now all erased the losses for 2025. We're trading in the green year to date. We are only 4% away from the all-time highs that we hit in mid-February. That is a number to keep in mind. A lot of the moves yesterday were driven by a rally in mega-cap tech. Nvidia shares over the last two sessions, Anna, have rallied near 12%, up 11.4% in the last two sessions. A lot of this driven by that optimism around what Trump announced in Saudi Arabia and some speculation that Trump is due to repeal some of those chip curbs that have hampered Nvidia's penetration into key markets. Lastly, though, Anna, I want to note that yesterday we were very much a traditional risk-on day. The dollar was weaker. It erased a lot of the gain that it had on Monday. Monday was one of the best days for the Bloomberg Dollar Spot Index since the U.S. election. A lot of that reversed after the soft CPI print. We're now trading 0.7% weaker on the U.S. dollar in the last two sessions.
Bloomberg's Valerie Teitel walking us through what feels like a very calm. If you look at that chart, everything's back to normal. What trade war, what volatility? Let's see if Becky Chin agrees. Multi-asset portfolio manager at Fidelity, joining us around the table this morning. Becky, pleasure to have you on the program. I'm going to put the trade conversation aside for just one quick moment, just so we can get the CPI story out of the way. You saw a major drop across the board when it came to CPI. Does it matter in this environment?
I think the CPI reading has been soft, both core and headline indeed. There's a little bit of a mixed message within that. If you look under the hood, I guess we see on the core goods side stronger. Much of that is driven by some of the initial impact of tariff. And on the core services, which I think will continue to manifest over the next 2-3 months. So it's hard to draw a conclusion from that, given the de-escalation that we've seen over the weekend. But on the core services side, we also see some signs of stickiness, I would say, that probably keep the Fed's hand continue to be tied over the summer. So I think the summer is going to be quite quiet for the Fed. On the one hand, the tariff impact will feed through the data, but it's probably still data. On the other hand, services is not yet giving the all-clear signal. So we've just got to see after the summer whether labor has continued to deteriorate and loosen up enough to the extent that the Fed might act.
Well, that key word that the Fed might act, they've ruled out any sort of front-running of that, of any sort of insurance rate cut a la Jerome Powell circa March 2019. Talk to us a little bit about how you actually factor in the Fed and what kind of lag you factor in terms of when it hits the hard data and when the Fed will step in.
I think the Fed will be watching the labor market as well. So on the inflation front, we think inflation will probably continue to be elevated. The base case for us from a macro perspective, it's still that an effective tariff rate, global tariff rate of 13%, and that having an impact of about 90% on inflation, 90 bips on inflation, and 100 bips, 20 bips on growth. And so that sort of combination is still quite stagflationary. And so inflation still will remain a concern for the Fed. But what we've seen on the labor market front is that whether you look at quit rates, you look at how long it takes for people unemployed to be able to find a job, or number of hours worked in the manufacturing sector, all those have been slowly deteriorating. So if we see that gather momentum, I think that will probably bring the Fed in. But for now, the Fed is wait and see.
Bit of corporate news that I just want to interrupt the conversation with. Hon Hai is out with figures. Taiwan closed, 50 minutes ago? But the stock was rallying into the close. Hon Hai's net income has come through at 42.1 billion. 35.52 was the estimate. The point here is that they've, on the net income line, they've done very well. If you take a look at the operating profit line, it looks pretty much in line with estimates as well. So Taiwanese companies in the tech space continuing to do very well. So it's going to be interesting to see what the read across is into the rest of the tech space. Becky, yesterday, tech stocks did really well. The US market's flying. Equities are up. Tech stock is leading once again. This feels very, very familiar. Was the tariff war a bad dream? I know you've just been through some of the details of kind of why it will have a lasting effect, but from an equity point of view, nothing to see here. Buy the dip, move on. That appears to be the right strategy. Does it carry on being the right strategy?
I think the significant rally is driven obviously by the immense amount of trade de-escalation, as you mentioned, but also the buyers have been, there are various forces of buying the dip, I suppose, supporting the market. I think quantitative strategies will have big part to play in that. Retail has had big part to play in that as well. As volatility dips from the peak of 50 on the VIX index, significantly again down to the high teens, that has a large part to play in that as well. What we have in the multi-asset business, however, is one that is around diversification. So we had taken down our recession probability as a result of the de-escalation, increased our reflation scenario, but the base case of stagflation hasn't changed. As a result, the protections such as options or defensive currencies that we had come into Liberation Day, we've taken some of that off. And that brings us back to a neutral risk stance rather than to chase this incredible rally.
Which is interesting because I'm hearing a lot of long managers saying kind of similar sort of story in terms of what we're getting around this rally. It's interesting that Hon Hai is guiding for a slower 25 revenue growth story. So maybe some impact starting to come through. Where does that leave us then, sort of going forward on a more medium-term basis with equities? Does the story continue to be money coming out of the United States, going into other markets? Is that how I should think about the world? You talk about rebalancing and a more balanced portfolio. Is it the US kind of stays where it is, the rest of the world comes up? How are you kind of, what's the framework you're thinking about when it comes to global equities and their relative value?
Sure. I think if you think about global institutional investors' asset allocation to dollar assets or dollar, that has been on a rising trend up until, I suppose, the trade war escalation. And so for that to rebalance back to historic averages, we still have a long way to go. And so that argument of fading U.S. exceptionalism and having a more balanced portfolio and less concentrated geographically or sectorally still hold. And to that extent, we have, find opportunities around the globe, but in specific sectors. So, for example, in Europe, we've continued to like the defense theme. In China, we continue to like the China tech theme. And in Japan, for example, Japanese banks continue to look good value to us. And even within US, apart from the tech and AI rally, we still find really attractive value banks, for example, where fundamental continue to be good. It gives you some cyclical upside, but valuation is not that stretched, especially given potential deregulation forces.
Becky, thinking about the aftermath of everything we've seen on the trade narrative and the weakness in the dollar that was a feature of that, one area that we saw perhaps helped by that, local FX debt, is an area that some investors talk about quite favourably. You like some areas of that. Does that continue to be, tie the dollar in to that for us? How does the dollar weakness that we've seen of late tie in there?
Sure. So the preference for EM local debt, as you mentioned, really came in back end of last year, early this year, where we've seen that, to get interesting yield for fixed income investors, last year high yield would have been a great opportunity because U.S. growth is strong. Even though spreads are tight, we've got great supply-demand dynamics. But coming into this year, as we've seen, credit continue to, up until Liberation Day, play very resiliently despite falling U.S. growth outlook. So that's the point where we think, OK, we've now got a less impressive U.S. growth, less U.S. exceptionalism, weaker dollar, and that is a good environment for global assets to receive flows, which EM local currency have had multi-year outflow pretty much since taper tantrum and never recovered from that. And they have attractive real yields. You get high single-digit real yields in an array of countries that pay you really well. And, the weaker dollar environment and EM disinflationary story allow EM central banks to cut rates or pause hiking rates or stop hiking rates. So that all plays into a nice theme to potentially support the EM local currency asset class going forward.
Becky, thank you very much. Thanks for joining us. Becky Chin, multi-asset portfolio manager at Fidelity. Coming up, we'll be back to the earnings stories this morning. The shipping giant Hapag-Lloyd issues a full-year earnings forecast with a wide margin of error. We'll discuss the trade uncertainty with the company's CEO. There's mention of geopolitical challenges. What have they seen since that deal, though, between China and the US? Any change? This is Bloomberg. This is the opening trade. 30 minutes until we get that opening trade for this Wednesday, the 14th of May. Let's have a look at the futures picture. Yesterday's equity session, we saw the FTSE underperform, but European stocks broadly up by 0.4%. That was followed by some decent performance by tech. The Nasdaq up by 1.6% over in the States. US futures point a touch higher, but the European picture looks a little bit more mixed. Once again, the FTSE looks as if it could underperform. FTSE futures then guide down by 0.3%. Euro stocks futures pretty flat this morning.
Let's talk about what's happening in the shipping sector, which seems absolutely front and centre right now as we watch what is happening with the global trade story. Germany's Hapag-Lloyd, the giant shipping container story, has reported for the first quarter. The shipping giant says full-year EBIT could be anywhere between $0 and $1.5 billion. The company saying tariffs have contributed to wholesale uncertainty amongst its customers. We're joined now by the CEO, Rolf Habben Jansen. Rolf, good morning. the highlights of Q1 2025, you start off at the top talking about the fact that Hapag-Lloyd recorded a strong start to the year, which was characterised by positive demand trends. You then go on to talk about the Red Sea and the uncertainty that there is there. At the bottom of the page, you talk about, in light of major geopolitical challenges and volatile freight rates, the forecast is subject to a high degree of uncertainty. How much visibility do you have right now, Rolf?
We have limited visibility, to be fair. And we just look at what happens on a day-to-day basis. I think we've seen a good first quarter with global trade up about 4%. We were up about 9%, so pretty happy with that. I think second quarter has been a little bit up and down so far. Of course, very much driven by everything that's happening on the tariff front. Initially, volumes from China to the US down with up to 30%, but of course, the last couple of days, we see a huge surge of volume, and now we need to see how long that lasts.
Can you quantify that huge surge of volume? Give us a sense of what is happening.
I mean, if we compare it to what we've seen in the last couple of weeks, it's up with more than 50%. So it's pretty significant, and the levels are definitely also higher than what we saw prior to the tariffs.
Rolf, that's interesting. Okay, so there's very real-time improvement in bookings then. Before you saw that improvement in bookings, we spoke to the Musk CEO a little while ago, and he was saying that the impact of the tariffs had been all across the US-China route, and the rest of the world had been pretty resilient. Do you continue to see rest of world shipping fairly resilient in the face of US tariffs?
For the time being, yes. I think we saw something similar because we're acting in the same market. I mean, bookings from China were down significantly. Roughly 50% of that was compensated by Southeast Asia, which was actually a lot stronger the last couple of weeks. And now, of course, we see a surge in bookings. At the same time, we see the other trades all remaining pretty stable. So no major change there, at least for now.
Okay, so a surge in bookings, China, US, but the rest of the world rather stable. What does that tell us about where Chinese goods have been going in the meantime? So that period where we saw a big drop-off in trade between the US and China, was Chinese shipping trying to go elsewhere? Was it staying in Asia? Was it trying to come to Europe? What can you tell us about that theme?
Difficult to judge from our perspective, but I think some of it has definitely been going elsewhere because we've seen a little bit of an uptake in some other trades, but for sure some of it has also been buffered and has been stored in China. And I think there is definitely a bit of a backlog today in China for goods that have as final destination US.
Rolf, Creedy in London, I hear you on the fact that you have limited visibility, but I'm curious, when you speak to the economists that work with Hapag-Lloyd, are you in any case forecasting or can potentially see the ingredients for a recession coming down the pike as a result, not just of the tariff war, but some other geopolitical factors around the world?
But that's a tough question. If I would have the answer to that question, I would probably be doing something else. I think when you look at the signals that we see over the last number of weeks, I think they're pretty mixed. Yeah? I still remain cautiously optimistic that we will not run into a recession, certainly because there have been a lot of talks around tariffs, and you see quite a lot of initiatives between various countries on talks that people that want to keep trade flowing. I mean, we saw Brazil, China, for example. We have the Mercosur EU agreement, and there's a few more talks going on here and there. So all in all, we need to see how that pans out. But I remain cautiously optimistic that in the end, we will be able to avoid a recession. But of course, it's still a little bit early to tell.
Well, Rolf, part of that argument, I think, from multiple sides of the Atlantic is simply that the end consumer may still be able to digest a little bit of price making from some of the corporates. So when you're speaking to your clients, what are you hearing from them? Are they able to absorb the cost themselves in terms of higher shipping rates, in terms of higher tariff rates, or pass them on? Do you have any sort of just anecdotally commentary on that?
Not a lot, to be honest. I think in the end, if there are tariffs and if costs would go up in the end, that will be passed on to the consumer. We have also seen that in earlier times. I mean, if we look at COVID, then we certainly saw that consumer prices were going up probably even more than the tariffs and additional transportation costs. So I think that threat is real. Yeah, but hopefully we will be able to avoid a fair bit of that.
Rolf, let's turn our attention to another part of the world, if we can, and that is, of course, the Red Sea. We know that a lot of the shipping has been rerouted from that area. Walk us through what the green light that you're looking for is when it comes to returning operations to the Red Sea. What do you need?
I think what we need is we need visibility that it is safe and that it is also going to remain safe for a longer period of time. Because what we want to avoid at all costs is to go in and out, because we shouldn't underestimate the additional pressure that there is going to be, particularly on port infrastructure, if Suez is being opened, because that in essence means that both in the Mediterranean, but also on the north continent of Europe and in the US, we'll get a lot of additional ships hitting those ports within a very short period of time. That has a real risk to create a lot of congestion, which is something that everybody wants to avoid. And for that reason, what we will try to do is that as soon as it's safe again, we'll make a plan to gradually go back through Suez to avoid that ports collapse and that we make sure that those supply chains keep flowing. That means 60 to 90 days probably, rather than from today to tomorrow.
Rolf, I'm listening to the conversation, and it sounds like the shipping business is going to be really lumpy. You're going to get big surges in orders when tariffs are not on, and then it's going to dry up when tariffs are off. We're going to see this kind of stop-start world potentially as a result of what is happening with the trade negotiations. You've got a Red Sea story that's hard to quantify. You don't know whether you're going to be in and out. How do you as a business manage that kind of environment, this more lumpy, uncertain, lacking in visibility type of world? You've got the deal with Maersk, Gemini. That looks like it's moving forward. To what extent is that going to help? How much can you manage fuel costs? What do you do as an operational story to manage what looks like uncertainty and more lumpiness in terms of the orders that you're going to be seeing from your customers?
Well, it's clear that we have to react quicker these days than what we saw maybe 5 or 10 years ago. I think the main thing we try to do is to adjust the capacity that we deploy based on the demand that we see. As an example, if we look when the tariffs came between China and the US, we started deploying smaller ships on the China-US trade, because that allows us to save some cost, but it also allows us to continue to offer our customers weekly sailings. What we do now is that we reverse that, which means that we will again deploy bigger ships on the China to US route to make more capacity available, and then we'll redeploy those other ships in trades where we feel that demand is potentially a little bit weaker.
Rolf, it's great to catch up. Thank you very much indeed for spending some time with us this morning. And that lovely backdrop behind you. Rolf Harben joining us on whatever the story is around shipping. It's hard to tell on a day-to-day basis.
Yeah, very volatile, it would seem. Staying with the German earnings picture, the industrial services provider Bilfinger has reported first quarter sales up 16% on a year ago. The CEO, Thomas Schulz, joins us now for his take on the business and the world. Thomas, very nice to speak to you. Thanks for talking to us. So you're broadly sticking to the guidance I see around sales, and you say there's no change in outlook, but you do say that political factors had a noticeable impact on customers' investment behaviour in the first quarter. That must at some point have an impact on the company, does it, or is it just orders delayed?
Yeah, good morning at first, and second, my dear colleague before had the quiet sea behind him, and that's actually how we see our business in such a volatile market. We flagged already a quarter ago what you just mentioned regarding US tariffs, political issues, Germany with the election, US with the election. So it's not a surprise for us. So we think and we see we had a good start with 17% revenue growth, EBITDA 50 basis points up, cash flow very good for the quarter, order intake 11% up, actually fully in line with that what we expected.
So that all sounds really positive, Thomas. So where does this show up, this political factors that mean that customers hold back on investment? Does that come through in your numbers, or will it come through in your numbers at some point?
Yeah, actually, you see it in the organic growth of the order intake. We said already that we see the first half of the year a little bit slower because it is more difficult for our clients, especially in the United States, to get government permits based on all the activities, what the government and related people to the government announced to cut and to reduce government offices by 50%, 60%. Then you have, of course, the impact on the speed these organizations are performing on permits, what our customers need to make their investment. So it creates a little bit more hesitation than in the US market. On the other side, we expected longer time in Germany with finding the right government and getting into action. That seems to be faster. So US with the tariffs, with the political impact, And Germany, with the new government acting quicker, we actually have an equal out on that, what we see for that, what we flagged already in the Q4.
Thomas, it's Credy in London. I want to get to the tariff conversation in a moment, but you just mentioned kind of how the German political landscape, and we know that last night Chancellor Merz raised the idea that the EU supply chain law should be scrapped. Your initial thoughts on that view?
Great. Whatever we can reduce in bureaucracy and data, tsunami to the companies and taking the focus away from innovation, from market, more to reporting, millions of data. We are highly, highly positive on that. Let's see what happens.
Let's see what happens seems to be the phrase of the day, or maybe of the several kind of the year, I would argue. Thomas, talk to us a little bit about whether or not some of the actions from not only the German government, but the European governments broadly can offset some of the worries that are coming from the tariff impact, the geopolitical uncertainty emanating out of Washington, D.C. Can you just walk us through what that looks like in terms of an effect on your business and how Europe can counteract it?
Yeah, fact is that we have since years quite a volatile market. Our customers are on one side expanding, investing, and having, of course, a lot of bureaucracy to fulfill, having labor shortage, competence shortage, supply chain issues, as we just heard, short-term, longer-term, mid-term. Then on the other side, we have industries, countries being under pressure, energy costs too high, bureaucracy too high. So what we see on both ends of our clients, the expanding ones and the ones are heavily under pressure, they look more and more to their core business. And we as Bilfinger, we offer them to outsource the adjacent non-core part, what is necessary to operate their processing plants, but not being directly in the product issue or in the product core of their production. Out of that, our outsourcing ratio, our business model works in both ends of the market very well. And you see that in the growth rates, you see that in the performance, what we have since 2-3 years regarding EBITDA improvement. So for us, the challenging market conditions, positive as well as negative for our clients, is good for Bilfinger as an industrial service provider.
Thomas, good morning. It's Guy. How much better will the Merz government be than what came before? People are talking about a step change in Germany. Germany is different now, and that we're going to see it much more aggressive when it comes to delivering some of the changes that Europe so needs, being much more aggressive. How big a change do you see? How big a difference will there be?
I make it like that. We have only a few minutes. It was very difficult to imagine that it could be worse than the former government. So any kind of improvement already helps a lot. And that is what we see. The whole setup, how quick the government found each other, already going into actions, actually is more positive than we hoped for, to make it fairly clear. Is it great? Yeah, of course, you can always have different opinions, but we see that they act, that they move, that this permanently talking and down-talking is more or less stopping and now going into activity. And that in itself is positive. And when you listen to that, I didn't say anything what they do, where we have plus for the industry, plus in and minus in. The other very positive is that the industry in itself is doing more to get, again, more competitive, which is important for Germany, which is important for Europe. We get more a voice in the society, what is necessary to be done to get Germany back on track, to get with that Europe back on track. And that in total is quite positive. And as I said before, for us as Bilfinger helping companies in these kind of situations, it's quite a favorable market.
One of the byproducts of all this excitement around Germany and by extension Europe is, you could argue, a stronger euro. Now, part of that's obviously down to a weaker dollar, but nevertheless, we've had a stronger euro since the beginning of the year. Some people are talking about it going to 120, possibly higher from that. Is Bilfinger ready for a euro-dollar rate at 120, 125?
Yes, we are ready for that, as well as we would be ready if it goes into the other direction. And I think that battle is not done yet, in which direction it will go. We are not supplying goods around the world. We have local people offering local service in the local currency. We have more than 90% of our business is repetitive business with local customers on processing plants in North America, Middle East, and all over Europe. So the impact of the currency is not that big for us, no matter which direction it goes.
No matter which direction, and as you say, maybe we haven't made up our mind which direction it's going to go in. Thomas, great to catch up. Thank you very much indeed for the input to the conversation this morning. Thomas Scholz, the Bilfinger CEO. Critty.
Absolutely. We're going to see how those stocks trade at the open. Fascinating conversations by those two German corporate companies. We're going to dive into that at the open in just about 15 minutes time. Plus, as Burberry's fourth quarter sales fall 6%, however, less than analysts forecasted, we're going to walk through what that market impact may actually look like that and your other stocks to watch coming up next. This is Bloomberg.
Welcome back. This is the opening trade. We are 10 minutes away from the start of European equity trading. Let's talk about the markets in 3 minutes. Our Markets Live executive editor, Mark Cudmore, joins us now with his analysis. Now, Mark, US stocks, the S&P, back in positive territory for the year. I know that US stocks not your favourite pick. They've already gone further than you thought they would go. But when you listen to US stock bulls, are there any arguments that they make that give you pause for thought?
Yes, absolutely. I think, first of all, you made the point, Anna, this relief rally, which I was anticipating, has already gone further than I expected, about 3% further roughly than where I thought we'd roughly stop. And there are a few issues that are concerning me as someone who was expecting the next leg of the bearish trend to kind of commence. And that is the fact that, well, for a start, the rally triggers some more technical signals. So you just have some follow-through momentum now. I think that the Saudi deal, while it seems like it's already less, maybe might be less impressive and less quick than maybe some of the initial headlines, was an extra win I wasn't expecting. Of course, the US-China trade deal surpassed elevated expectations. So I think there have been a few wins recently. And the fact is, China-US trade hasn't collapsed off a cliff quite to the extent that people worried about. Yes, it's dropped a lot, but we've seen drops of this before. It's nothing too dramatic yet. So I am a little bit concerned. It feels like the hard data slowdown from tariffs may not come, be show up till May, which we kind of always thought, May or June. But that means we won't actually see that data in prints until maybe, July or June at the earliest. So I'm a little bit worried the squeeze might go a little bit further. And therefore, given that I'm getting the short-term direction is not working out as I expected this week, I'm kind of pulling back from the short-term calls, and I think that I'm retrenching to the longer-term ones this year, which I think remain incredibly strong, and that is bearish dollar. It is generally a tough environment for US Treasuries, and it is that US stocks will continue to underperform global stocks, as they have for the last couple of months, and those trades, short dollar and bearish dollar and the idea of US stock underperformance are trades that have worked well for the last months and will continue to work well.
It doesn't sound like we're going to get a lot more volatility, though, from what you're saying. Is the volatility story done?
It's interesting that there's not much data quickly on the horizon. We're going to start getting retail sales. I'm wondering where the next catalyst is. And that's the thing is dip buyers have won, particularly in the retail sector at the moment. And that's why I'm a little bit more hesitant to reiterate my kind of bearish view that I have for most of the last week in terms that what is the catalyst for us to get negative now? Now, there are going to be some catalysts, but when? And so those three things I'm looking for is I think the fiscal story will get people worried about yields. The fact is the fiscal situation is getting worse this year, despite all the headlines from Doge. So that's going to raise concern about yields again and yield curve steepening at some point. But when? That might be another month away. Hard data, when that turns lower, and I'm expected to, that'll be dramatic. But again, that might not be for a month or so. It could be as soon as retail sales this week. I'm not expecting it. It could be on jobs data sooner, but I can't definitely predict that. So data, and fiscal situation. And finally, I'm expecting the marginal news flow and trade to turn more negative from here. So that's the other catalyst. But I can't predict timing of any of those.
Bloomberg Markets Live executive editor Mark Cudmore's thoughts in 3 minutes. We thank you so much. Let's get our stocks to watch now with Joe Easton from our equities team. Joe.
Morning, Critty. So Hapag-Lloyd missing on a few key elements of their earnings report today and unsurprisingly warning of uncertainty in the shipping market. But as the CEO explained earlier on the show, they have seen an uptick in volumes in the past few days, given the headlines around trade. So we'll wait to see if that supports the stock, given the declines we can see over the past year. But this stood out for me, not a single buy on the stock among 13 analysts, 7 sell ratings on that. Clearly, sentiment is low on that one. Then, over in France, Alstom looking a bit weak as well in terms of the cash flow and no dividend at the maker of French trains. Now their outlook in terms of their order backlog does look pretty strong in terms of the train orders, but the long-term cash issues continue to weigh on that. We can see that stock already down a lot recently. Then in terms of Burberry, it's a case of not as bad as expected, but still pretty bad. Asia sales particularly weak. Over in China, we're down around 15% on the sales on the quarter, but given how much that has underperformed the luxury sector over the past year or so, potentially that's going to be priced in slightly better than analysts expected for Burberry today in London.
All stocks we watch, we're going to be watching at the open. Joe Easton, we thank you so much. In the meantime, futures virtually unchanged right now. Eurostoxx 50 futures, like I said, unchanged, but underperformance in the FTSE 100. The opening trade is up next. This is Bloomberg.
Wednesday morning, good morning. On the face of it, this chart looks really boring. In some ways, Tuesday's session was really dull. The problem with that analysis is that basically you need to look at the 3-day chart on your Bloomberg to appreciate the massive gap that we had out of Friday into Monday, and then the kind of steady gains that we've seen, particularly out of US markets since then. Yesterday, yeah, we dipped a little bit into the close for Europe. The US market went up, but continued to go up, and I think that's the important point. But you need to take a step back, and you need to see that massive gain that we saw at the start of trade on Monday morning to really appreciate how far equities have come. But today looks like a relatively quiet session once again. I think consolidation maybe is the word of the day, Chrissy.
Maybe it's take a step back. I think that's the phrase that maybe is driving these markets, and that we are not actually seeing any active selling, really. I mean, your biggest move to the downside, Anna, this morning is in FTSE 100 futures, and it's only down 0.3%. So no active buying, but no active selling either, when Eurostoxx 50 futures, US futures, and CAC futures, and I would say DAX as well, are all unchanged going into the open.
Yeah, worth noting that US futures point just a touch higher, up by 0.3% on Nasdaq futures, for example, after a decent rally in tech stocks yesterday. Let's have a look at some of the individual stocks that could be on the move here in Europe, and Joe went through a number of them for us. We'll reiterate and increase the list for you. Hapag-Lloyd certainly in focus. EBITDA margins missing estimates, but the CEO telling us he's seen a huge surge in volumes in the last couple of days, which has to be worth, was worth a headline, in fact. TUI in the travel space, really interesting here, sticking to their guidance, but Bloomberg Intelligence cautioning that bookings look a little bit soft. Burberry in focus, retail comparable sales down by 6%. That sounds bad, but it's not as bad as had been expected, Guy.
Absolutely. So here we go, the Wednesday session. Monday was extraordinary and breathtaking. Tuesday, a little quieter. Wednesday feels potentially even quieter than that. So here we go. Let's show you some numbers, give you an idea of what is going on. How far will today's session take us? Well, as you can see, the FTSE 100 barely budging. No movement there to see at all. Consolidation appears to be the operative word here. Stock 600 expected to go nowhere in a hurry either. And there you go. That is what we are seeing on the screen in front of us. We are after the huge story of Monday. The session on Monday was just epic. And then we get Tuesday, a little quieter, Wednesday, a little quieter, and that seems to be the theme. As Mark Hudman was saying just a moment ago, where does the next catalyst come from? In many ways, it wasn't CPI. Does it come with the data out of the United States a little later on this week? I don't necessarily know, Critty. What are you seeing below the surface?
It's interesting. It's kind of a tale of two tech stories, and I think that's what's driving the market, both to the upside and the downside, when you look at some of these movers and how this is all shaking out. But look, we are still waiting. I think the key word is waiting for things to shake out. I'm seeing 292 stocks in the green, 219 in the red, and 91 that are unchanged, that have no direction at all. And I think that red and the green, the Christmas basically that you're seeing on your screen, tells you everything.
Yeah, Christmas in May. It's an odd world. But yes, in terms of looking for the next catalyst, I mean, we've been so focused on all the headlines coming out of the White House, rightly, around trade. Is the next catalyst perhaps in the hands of the Kremlin? We still have not heard from Putin as to whether he is planning tomorrow to be in Turkey, and that obviously would be a big market moving, or market focus at least, with the potential to move markets depending on what we're agreed there. In terms of of the individual sectors then that we're watching this morning, I'm looking at to see if we get any weakness in travel and leisure as a result of that TUI line. Not any yet, because that's the best performing sector. It has to be said it's more to do with the leisure side than the travel side right now. But we'll see whether that TUI statement has any impact. But that share is not open. That share price is not open, nor is Burberry, nor is Hapag-Lloyd on my screen. So there we are.
So all the juicy ones
nearly 2 minutes in, and we can't tell you how they're trading yet.
No, but we can tell you how Alstom is trading, and that was one that Joe had watched, beating this morning, down about 10% on that French stock.
Absolutely getting whacked this morning. Shares down really, really hard. One of the biggest drops that we are seeing around Europe. Cash flow was a factor. Looks like the margin guidance story is a factor there as well. So an industrial company that certainly is feeling the story of the global slowdown, maybe. It's talking about a 2026 adjusted EBIT margin of around 7%. That's a little softer than anticipated. So the market really punishing this story this morning. So interesting, we are getting some single stories that are moving in terms of kind of what's happening with Burberry, what's happening with Bilfinger, what's happening with these other stock stories. In a market that's not doing much, it's going to be interesting because actually you'll be able to see maybe a more accurate reflection of what the single stock is doing in a market that's not overall doing anything else. Yeah, we're certainly not dominated by one trade narrative. We've had a lot of headlines out of Saudi Arabia. We continue to watch, and we should mention that President Trump and Mohammed bin Salman are expected to speak again this morning, imminently. Yeah. So we'll certainly be back there, and our focus will be taken there. But in the meantime, yes, some of those individual stories cutting through. TUI down by 6%, for example, this morning. Absolutely. Well, I feel like we're maybe waiting for some guidance, some direction from these markets. So in the meantime, let's get some analysis from a true expert around our table. Fabiana Fedeli joins us, CIO for Equities and Multi-Asset and Sustainability over at M&G Investments. Pleasure to have you on the program. Thank you so much for coming in and joining us this morning. Guy made a crucial point in our interview with Hapag-Lloyd in the last hour, which is simply that we are in a stop and start environment because we don't know what the tariff story looks like, what federal contracts look like, what spending looks like from really anywhere except for maybe Germany. And even that is raising some eyebrows. Walk us through how you price that in to this market.
So, Kriti, good morning. I think the U.S. administration has made a pivot in its policy. If you remember, weeks ago we were talking about we really don't know where this is going. It could be more tariffs or there are going to be negotiations. There is a feeling that the policy is starting to change, that actually the tariff narrative is mitigating. That is a positive. Whether this is because of the administration being concerned about what happened, for example, at the long end of the U.S. Treasury curve, possibly less so in equities at the beginning of April, or whether it was part of a big plan, right? Go in, shock and awe, create confusion, and then start negotiating. Something is happening, is giving the market more visibility, which is what you're seeing right now in equity markets. And also you're seeing it at the long end of the Treasury curve, where there is some kind of normalization, and in credit markets.
Do you buy risk assets on this thaw?
So we have been buying risk assets, but as we've said before, when you have uncertainty on the macro side, you really have to point to the micro. So you have to really be very idiosyncratic on the stories that you're buying. And Anna, you were talking about very different earnings releases, very different discussions, company by company. We've seen this over the last few earnings releases, and even more so now. And by the way, we're seeing it not only in the U.S., but across the world. I was looking at some research on that subject of the earnings story. I was looking at some research by Morgan Stanley that pointed to an increasing number of companies citing pricing power as one of the ways they plan to get through this, which sounds good for margins and bad for CPI if you don't want CPI to go much higher. So do you see that, Fabiana? Is that a big theme coming out of this, that companies are once again, just like we saw in the early days of COVID, talking about their pricing power? Absolutely, and that is very important when you choose a company to invest in. It's not only pricing power. The pricing power comes, for example, from the ability to innovate in line with what your consumers require, and there are companies that are able to do that. To your point, however, this also would mean more inflation if some of these companies were able to pass on those increased costs onto their consumers. So tariffs and a mitigation of what we're seeing right now on tariffs are really important for the economy.
And so you see US businesses that are very well worth still investing in, don't you, Fabiana? Because, yes, you think that, OK, so US exceptionalism may be changing, evolving, but I think one of the notes that stood out to me, empires don't fall in one day. Yes, diversify, but don't divest from the US.
There is no other alternative to the US. I mean, the US exception is true and is very clear when it comes to innovation, it comes to entrepreneurship, it comes to very deep capital market. But the US is not the only game in town. There are other areas where you can invest. I mean, Europe has a lot of good opportunities. Asia has a lot of good opportunities. But what we have seen in the US was that there was a sell-off in technology, which was unwarranted. I mean, not only technology stocks are the same. So actually, in our strategies, we have started buying into technology stocks when we saw the big sell-off.
Do I buy dips still?
You buy dips, but you don't buy them everywhere. You buy dips where you have conviction that the fundamental story is still there. So, for example...
United States. Do I buy dips in the United States?
For example, we bought the dip in AI-focused semiconductors because we felt that that story was still intact.
How much of a headwind for European investors investing into the United States will be a weaker dollar? Do you anticipate a weaker dollar?
So it's interesting. If you think about the dollar, it has reset over the last 5 years, right? It was weaker during the preceding period against the pound, against the euro. So we've had a reset and a stronger dollar. It could weaken to some extent, but I think that story is really going to be related to what happens with tariffs on the shorter term.
But how big an impact is it going to have in terms of my investment returns? The Nasdaq is now only down by 1.5%. Year to date, I think, for a euro investor, still down nearly 10%. Like, how big a factor is that going to be?
It will depend on how the equity market and the treasury market is going to perform, because the moves in the dollar, while they're surprising, they're not huge, right? They can be offset by equity market gains and gains in the treasury side.
So you're going to get more upside in the US, even taking out the dollar trade, even if the dollar's negative. I'm still going to be better off in the US.
No, that is not what I'm saying. Because, for example, in most of our multi-asset strategies, we are underweight the US.
Okay.
But we still find interesting pockets there. So we shouldn't just give up on the US market. But clients are diversifying. When I talk to clients, they're talking more about Europe. They're talking more about Asia.
So when you say you're underweight the U.S. relative to the rest of the world, I'm going to ask the opposite question that Guy did. He said, do you buy the dips? Do you sell the rips then when you start to see rallies like today's?
We have been very idiosyncratic in our moves. I mean, we've seen some companies that have performed very well early in the whole tariff debacle, and we have taken some profit from those companies to reinvest in areas where we thought that the dip was unwarranted. So there has been a bit of recycling of our assets in areas that we thought, you know, this is a good time to go in. Possibly in the past they were too expensive.
Where does this leave for European stocks for you, Fabiana? We've talked quite a lot about US tech, and I was reading a piece earlier this morning that suggested everyone's been so busy buying European stocks this quarter that maybe they've been missing that US rally. You clearly not then, if you've been using the opportunity to buy the dips in US stocks. But what's the balance into Europe at this point?
We still like Europe, and by the way, it does feel that over the longer term, some of that overweight that we had in the U.S. is going to move towards Europe. I mean, clients are asking more and more about Europe. Clients are moving money to Europe. Again, there is a lot that is going for Europe. It's not true for every country, every stock. But if you think about what is happening with defense spending, which clearly can permeate more than one sector, if you think about the package, the infrastructure package in Germany, potentially a peace in Ukraine could be a positive, right, particularly for gas prices. And then last but not least, let's not forget the Draghi report that was requiring or asking Europe to improve the efficiency of its industry, to cut bureaucracy, to cut red tape. Possibly Trump is going to do that for Europe because Europe has to find a way to make its industry more competitive now.
Let's hope you're right. And whatever the force that drives that, it is definitely required. Fabiana, thank you very much indeed. Nice to see you. Fabio Fedeli, CIO for Equities and Multi-Asset and Sustainability at M&G Investments. The Core 6 looks a little bit like this morning. Let's show you some numbers, give you an idea of what is going on. It is a game of two halves. Well, slightly biased one way or the other, but actually we're not seeing huge movements for any of these stocks. As you can see, luxuries are down pretty hard this morning. LVMH under a little bit of pressure. Burberry's not. Burberry's having a very good day. There's an interesting article in the FT this morning talking about LVMH, or at least its drinks business. Novo Nordisk's a little soft as well, down by 0.6%, but not huge moves in any of the major stocks that we are watching. Let's see what else is going on, because there are some huge moves elsewhere, Joe Easton.
So one huge move, Guy, over in France, turning into a really rough day for Alstom, the French train company. Now, the cash flow weak, once again, missing expectations, and no dividend. Those seems to be some of the key lines coming out of that statement. The actual order backlog, as we said earlier, looked pretty decent. Traders telling me, though, it is the cash flow that looks weak, though. Even that move, they're down almost 15%, surprising some people given the calls we saw pre-market. So really the biggest move we've got today. Then another one looking weak is over in travel. We've got TUI, the company, warning of some slower than expected bookings, potentially a little bit of that due to the timing of Easter, according to the statement. But it doesn't seem to just be a timing effect, because we're seeing that stock down almost 7% on the German market. The underlying loss also does look to be potentially a bit better than expected, but actually mainly we are seeing weakness across that one today. Then in terms of Allcon, this is over in the eye care and also some of the other medical tech parts of the pharma market as well. Weakness after the close of trading yesterday. That's a big firm, about a 30 billion market cap over in Switzerland, much weaker than expected in terms of the quarterly results. So Allcon really leading losses among the medical tech firms today. A bit of a weak one for us this morning. Then another one, lots of red today. Pretty much all the stocks we're picking out actually declining. Imperial Brands, one of the biggest weights on the FTSE 100, missing estimates once again. The second week report in just a few months from that company. A lot of focus, of course, on the vaping market and also potentially the regulatory changes here in the UK. And potentially that is weighing on that in terms of the profit miss. So Imperial Brands, a big weight on the FTSE, as I say. Imperial dropping at around 7% this morning. Then finally a couple of green bits for you. Hapag-Lloyd, the CEO, earlier talking about potentially a boost in volumes in the past few days, given the update in terms of the US trade. Potentially that is actually making up for that miss on the margins that we've got down at the bottom of the screen there. Potentially just a bit of a rebound for Hapag today. And then Burberry, probably the best day we've had for Burberry for a while. A bit of positivity finally for Burberry, seeing that stock gaining 8% today. That's despite Chinese sales down 15% or more in the last quarter. As we can see, the bottom there, the sales down yet again, but not by as much as expected. So it's a rebound story with the stock down around 50% over the past 2 years. So Burberry rising in London following a positive update in the luxury space.
Thanks very much, Joe. Joe Easton from our equities team with the rundown of those stocks on the move. He was mentioning Hapag-Lloyd, and we did speak to the CEO earlier. Really interesting conversation around the amount of visibility, limited visibility he concedes, just as the rest of us are dealing with limited visibility when it comes to tariffs and trade. I was interested in what he said about surging bookings, though, coming back. So just days after we saw that meeting in Geneva taking place, that's already evident in the very high-frequency, real-time bookings data that they're looking at.
It's interesting, we just put bigger ships on. Seems to be the answer.
Yeah. What levers can you pull? Well, we can move big ships and small ships around.
Presumably they don't move that fast. This takes a while to get things moving. So I wonder how quickly the environment will adapt, and whether the early kind of surge that you see has to wait a while, because actually the small ships are still largely scheduled and the bigger ships are on their way. Anyway, be interesting to see how long that takes.
But that's not really, even in that mechanism, that's really not tackling the problem, which is that you can have a ship en route and then the tariff thing can change, and then you get to the port and you're charged a different rate. So to your point, that doesn't really work to the same extent.
But in theory, aren't we now in an environment where we've got 3 months, 90 days, effectively, in which everybody seems to be like, right, if we want to get into the United States, now is our window. We don't know what's going to happen after that. Go.
Yeah, so he's anticipating a big surge, I suppose, in the short term. And then even if we're back to higher tariffs at some point, who knows? I suppose it's damage limitation. You operate with the levers you can pull, and if these are the few levers you can pull. I thought it was interesting you asked him about the Red Sea, Critty, and he was saying, yes, sure, giving us analysis of the geopolitics, just as every boss in the shipping industry will be doing, but also sketching out how long it will take for that traffic to come back, even when you make the decision, yes, we'll go through there again. It's not day two, you're back. It takes a while to build up.
And it was also the same 60 to 90-day time frame. So that's what we're talking about here. I think if you're this is what I'm trying to work out, is that when you have all of these kind of changes that are happening, how do you price it into this market? If you're a stock picker, how do you say, I want exposure to this? And this is what I think about at night when I can't sleep, which is I think you...
on this shift, quite common.
Right? You have to, especially on the Sunday scaries. But I think it's really important that you look at companies that have way more liquidity, way more flexibility, and a lot more companies do because they've had to do it post-COVID. So are those the companies then that you expose yourself to? I don't know.
Yeah, maybe. Interesting. I'm just captivated by the idea of sleep now. I find it all too easy to sleep, which is strange. Right, 16 minutes past 8 here in London. Coming up on the programme, Burberry shares surge as the company says it plans to cut up to 18% of its workforce. We'll dig into the luxury company's earnings next. This is Bloomberg.
It would be very exciting to have autonomous vehicles here in the kingdom.
Indeed.
If you're amenable.
You heard it here from Elon. He's bringing his Robotaxi to the kingdom.
Yeah.
He has another announcement that he's going to share later.
Exactly. So, and I'd also like to thank the kingdom for approving Starlink for maritime and aviation use.
That was, of course, Elon Musk, the Tesla CEO, the CEO of many things, speaking at the Saudi US Investment Forum, which is taking place in Riyadh. It's interesting, from a technology point of view, the Gulf is actually seen as being quite a positive operating environment. Many of the technology companies, you see this with drone technology, you see this with autonomous flying, autonomous driving, low regulation environments, relatively easy to navigate kind of spaces. And it's seen as, in some ways, as an easy place to start off delivering some of this technology rather than highly regulated places like Europe and parts of the United States as well. So in some ways, it's an obvious trade for Elon Musk to make.
I thought it was fascinating because he's making those comments also in light of Donald Trump and the U.S. administration raising some of the limits in terms of getting chip technology, military technology to a part of the world that has long been a consumer of American defense, but is also not gotten the full access that I think perhaps other allies like Europe, for example, has gotten.
And we're waiting then for news flow surrounding access to Nvidia chips, AMD chips for Saudi Arabia and the UAE. We should say we're waiting for a press event to take place, basically, between President Trump and Mohammed bin Salman of Saudi Arabia. So when we see that, we will be bringing that to you. So we're waiting for that. There was plenty said yesterday, and there were plenty of US executives in the rooms of Saudi Arabia to listen to all of this narrative, co-investment, one to the other. I mean, Musk was there. We have Jensen Huang was there, Larry Fink, Steve Schwarzman, Jane Fraser, many titans of Wall Street and US business in the room to see what they can lend to this sort of US Saudi push.
Lend from it or take from it? The numbers are pretty big. And there's obviously business to be done, and Trump is spearheading that, and as a result of which, they're very happy to tag along. I'm trying to think if there's a sort of tagline that I can use to get into Burberry. I'm not sure there obviously is, but Burberry shares are up quite nicely this morning.
Well, I'm struggling with that same segue. Right, Burberry shares surging as the company says it plans to cut up to 18% of its workforce. Fourth quarter sales fell 6%, slightly less than analysts had forecast. Lots of interesting lines coming through from Burberry around their operations in the UK in particular. Deborah Aitken, senior luxury goods analyst for Bloomberg Intelligence, joins us now. Deborah, good morning. So the stock's up 8%. The numbers, they reported a drop, but not as bad as expected, and they are taking action on the cost base. I suppose that's something that the investors are applauding this morning.
Yeah, I think it's about the forward view. There are no specific targets, but when we look at what's happened and the momentum through the second half of the year, we tried to break down the numbers. You know, they've guided down a couple of times this year, a slight beat in a couple of areas, but not much. So we saw top line down operate a 15% operating margin, fall to 1% adjusted operating margin from 14%. Big take back on things like their inventory, where there was too much in the marketplace. And under Josh Schulman, the new CEO since last July, he's really looking at Burberry forward and focusing on the core. And that's the idea. And within that, between November, when they announced their first update, to now, they've found an extra 60 million per annum cost savings through 2027. So 100 million in total, and that includes, as you've mentioned, some of those job cuts.
Well, Deborah, walk us through some of those job cuts, because we're getting headlines crossing the terminal now from the Burberry CEO saying that those jobs cuts are targeting the office and the retail roles. We're seeing a market that is rewarding Burberry for what they put out this morning. And I'm curious how much of that is due to that organizational change. This is, I think, one of the latest series of organizational changes that Burberry has had.
Yeah. So there are 1,700 job cuts. I think some of the headlines say that's around 18% of the market, cutting out things like overtime, overnight, reducing volume, which is needed in this marketplace. And I kind of think that this is Burberry working a little bit ahead of the curve in some ways, given that it's in a strategy overhaul. It's focusing on core. It's been bringing down some price points in categories where it doesn't have the right to have those prices, according to the new CEO and the market in general, given demand has been so difficult for the last couple of years for them. And I think we'll see more of this overall come from other companies, given the biggest issue in the marketplace for luxury right now and the changes between tariffs, day by day, week by week, country by country, is about consumer sentiment. So for Burberry, it's about getting the brand back on track and really kitchen sinking while it can. Yeah. And I think that the market is appreciating that and saying, OK, we start with a negative net profit. We start from a base and maybe we get back to sales growth within a 12 rather than an 18-month view.
I've heard of the Castleford Tigers, the rugby league team. I hadn't heard of Castleford, the factory. They're cutting the overnight shift from. Is this what we're going to see elsewhere?
I believe so.
So you talk about the big ahead of the curve. Presumably this is going to have to be, therefore, writ large across the entire luxury industry. Is this something that LVMH is going to have to do? Is this something that, dare I say, even Hermès might have to do? How far does this reach? How far does this strategy reset reach into the luxury sector, do you think?
If we think about Burberry in particular for a second and combine it with the likes of Gucci brands, Salvatore Ferragamo, what's been happening with Michael Kors and others, they've been brands over the last couple of years that just haven't resonated and they've had to make big changes. Yep. And Burberry is probably one of the first to really start to come out at the other end a little bit, though it's still a long road ahead and bumpy. Yeah. But if we look at Hermès, for example, Brunello Cucinelli and others, their volumes are restricted, so that's a different programme. Okay. And within the LVMH group, it's about looking category by category. So the Moet Hennessy side, looking at cognacs being difficult in the marketplace, some of the watch volumes and others. So I think we'll be taking it brand by brand, company by company.
Deborah Aitken walking us through the luxury story this morning from Bloomberg Intelligence. We thank you so much. Coming up, we're going to shift our focus right back to the Middle East. Donald Trump meeting with the Syrian president right now. We're going to get more on that next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session. I'm going to say we're not actively selling here. Eurostoxx 50 are down about 0.1%, and your biggest weight this morning is coming from LVMH into the CAC Iran. And even then, the French index is only down 0.4%. Caution seems to be the name of the game across of these indexes. But again, let's wait and see what happens on the geopolitical front, because, of course, Donald Trump has arrived at the GCC Leader Summit taking place in Riyadh. And at the moment, speaking to the Syrian president, let's go right there to Riyadh with our very own Horizons anchor, Jumana Bersetchi, joins us now from the Saudi capital. Jumana, as I said, Donald Trump in a historic meeting with the Syrian president. Walk us through what we can expect from that conversation.
Yeah, most definitely, Kriti. And if yesterday was about deal-making, those flashy announcements of investments and MOUs, agreements signed between Saudi Arabia and U.S., today the focus is going to be on regional security. Also unprecedented to have an American president chair what is a GCC leaders summit that is taking place right here in Riyadh. And in a few moments, we're expecting to see a family portrait photo taken with those GCC leaders, some of them being represented by the Crown Prince, as in the case of the UAE. But the other major headline that came out of Trump's speech yesterday was his announcement that they are looking to remove sanctions from Syria. It came as a bit of a surprise. He credited the Crown Prince for pushing them in that direction, and of course gives further legitimacy to this very nascent Syrian government that is being led by Ahmed al-Sharaa. And Ahmed al-Sharaa himself was invited to the GCC summit that's taking place right now. As we understand, the two are engaged in a bilateral meeting. So this is President Trump meeting with the new Syrian president, having a conversation now. Overnight, the foreign ministry put out a statement saying they welcome the removal of these sanctions, that Syria wants to use this as an opportunity to rebuild and focus on economic prosperity after a decade of war, civil war, sanctions that have crippled the economy and has led to a huge reconstruction need that is going on in Syria right now. So it is a big deal, and it's also noteworthy because Ahmed al-Sharaa, the Syrian president, has only had one visit abroad outside the Middle East, and that was to France last week. He met with French President Macron, and so this just is another step in the direction of adding legitimacy to that government, and it's part and parcel of the Trump administration's bigger plans, which is ultimately what they want to do is to make sure that this becomes a region of stability, of economic prosperity, and to move away from one of wars and strife.
Jemana, what is the overlap now between US foreign policy and Saudi foreign policy?
Yeah, I think that's a very pertinent question to be asking, given that the U.S. came here and President Trump came here talking about these huge ambitions and deal-making. And perhaps the media, we got a bit caught up with some of those headlines and thinking that there wouldn't be as many geopolitical breakthroughs. But I think from the Trump administration's perspective, yes, economic prosperity, economic opportunities are going to be front and center, but at the same time, in order for that to happen, you need to see stability in the region. From my conversations with GCC leaders, representatives over the last few months, they talk about de-escalation. They talk about bringing down the temperature in the region. And it's very welcome, I would say, from Saudi Arabia's perspective, that in his speech yesterday, President Trump talked about wanting to make a deal with Iran. And remember, Iran and Saudi Arabia only last year had their own form of a détente because up until then there had been an active animosity between the two sides. But the Crown Prince, in light of his vision and diversification efforts and the focus on the economy, wanted to sort of ease things on that front so that there could be a focus on opening up the country. And from Saudi Arabia's perspective, look, Crown Prince got a lavish amount of praise from President Trump yesterday. He really went out of his way to talk about what Saudi Arabia is doing. He firmly placed Saudi Arabia on the global map, both geopolitically and economically. You had many of these very senior U.S. business leaders fly in for that summit yesterday. The likes of Larry Fink saying in one of the panels, traditionally Saudi Arabia was perceived to be an exporter of capital, but now it's positioning itself as a destination for investment. So again, an evolution from an economic standpoint, which is what the Crown Prince is really trying to showcase to the world.
And we saw that on display from some of the US tech names on this tour with the president. Thank you very much, Bloomberg anchor Jemana Bessetta, of course, in Riyadh for us. Let's lend a European dimension to the conversation around the Middle East. The French President Emmanuel Macron has urged the European Union to step up pressure on Israel over the humanitarian situation in Gaza. For more, let's go to Bloomberg's Caroline Conan, who's in Paris for us. Caroline, Macron accused Prime Minister Benjamin Netanyahu of Israel of shameful behaviour in blocking aid to the Palestinians. Is this a toughening of the language? How much other support is he getting from the rest of Europe?
Yes, in fact, Macron spoke on a live television last night for about 3 hours. We were expecting him mostly on domestic issues, but he made headlines on the international issue, especially what he was saying about the Israeli Prime Minister Benjamin Netanyahu, that could be interpreted as a change of tone, perhaps toughening his stance on the Israeli Prime Minister. We know that Emmanuel Macron has been pushing for the creation of a Palestinian state, of a double state solution with Israel and Palestine. We know that Emmanuel Macron actually recently, at the beginning of April, went to the border between Egypt and Gaza and said what he saw there was very brutal. So last night, again, he repeated what Israel is doing in Gaza is unacceptable, blocking this humanitarian aid and access to water for the Gaza people. He actually also is trying to push for some kind of normalization between Saudi and Israel, which is kind of interesting given what's happening at the moment with Donald Trump's visit to Saudi. Donald Trump, who actually said yesterday it was kind of his dream to see Saudi join the Abraham Accords with Israel. So clearly Emmanuel Macron is trying to get some kind of shift to European tone towards Benjamin Netanyahu. This comes also after the Netherlands already said that perhaps we need some kind of collective reassessment of the European policy towards Israel.
Caroline, walk us through some of the other highlights outside of some of the geopolitics that Macron was talking about.
So what he was expected to announce was some kind of referendum. We know that Emmanuel Macron said in his New Year's Eve address that the French will vote on something at some point this year, and he repeatedly denied that he's going to call again new snap parliamentary elections. However, he is willing to call the French to vote on a referendum on a number of issues, perhaps assisted suicide, perhaps access of children to screens, of perhaps even reforming the voting system to make a bit of proportional system rather than the two-run system for Parliament. What he excluded last night was a referendum on the retirement reform. He doesn't want to move the retirement age that he spent months to raise to 64 years old a couple of years ago amid months of protest. And also he doesn't want a referendum on immigration, which is something that the far right has been demanding. So we could see a multiple question referendum in the fall, and in fact a majority of the French is in favor of that. We could also possibly see a referendum on debt and deficits, which is what the Prime Minister François Bayrou has been suggesting. The risk, of course, is to make this a plebiscite for or against Emmanuel Macron.
Yeah, that's a significant risk, and he's taken big risks in the past, and they haven't always necessarily worked out for the president. Caroline, thank you very much indeed. Caroline Cullen joining us from Paris. Let's turn our attention to what is happening in the UK, where the Defence Secretary says the UK and the EU are in the toughest stages of talks, aiming to secure a common security and defence pact. John Healey spoke to Bloomberg's Lizzie Burden about his goal to secure access to European spending programmes for British firms.
Well, we're in the sort of hardest yards of the negotiations. We're a government that even before the election said that the security challenges we face in Europe require the UK and the EU to work closer together. We've been willing and ready to do that, and we've said from the outset that we're ready to strike an agreement if the EU will do so too.
UK Defence Secretary John Healey speaking to Lizzie Burden. A lot of moving parts around the UK at the moment. You've got this defence story which is developing. Are we going to see some sort of a deal done around that? It looks like obviously some progress has been made, more potentially to come. But we're also looking at this immigration story as well around the youth mobility scheme, which is really kind of beginning to heat up and probably will heat up more over the next few days. It's interesting to juxtapose it with the push that Starmer has made recently on curbing immigration, this potentially speaks to the other side of the coin on that one.
And how much can you sort of divide it by generation and keep the views separate will be a tough political challenge. Back to the defence theme we were hearing there from the UK Defence Secretary. Well, NATO is sketching out plans to meet Trump's call for 5% spending on defence, which goes a little bit further than what the UK has already set out. This is by 2032, according to some of our reporting, as we build our way towards NATO meetings taking place this week as well.
Yeah, it's fascinating, especially going into the potential talks between Ukraine and Russia into the next 2 days, where he specifically, John Healy, I believe in our interview with Lizzie Burden, said that Russia is not taking Ukraine peace negotiations seriously. So also keeping one eye on that.
Yeah, lots of geopolitics to focus on, lots of trade conversations to, of course, keep under review. With that in mind, coming up, we'll be speaking to the Renault brand CEO, Fabrice Camboulive, about how the company has been navigating Trump's tariff turmoil. Less exposure to the US than some brands, so perhaps that's an advantage, but it has the potential to disrupt entire supply chains. So we'll get into that next. This is Bloomberg. Welcome back to the opening trade. We're 44 minutes into our European session, and this is the picture we have for European stocks right now. The FTSE is entirely flat. A little bit of underperformance on the CAC and the DAX right now. Some corporate earnings cutting through. The bigger picture, macro drivers, though, a little unclear right now. Where does the next catalyst come from? US futures look almost entirely flat. Slight upside then, Guy, when it comes to NASDAQ futures. We had a good day for tech stocks yesterday, and perhaps we see a little bit of that, but really not much in evidence.
No, a little bit of a cautious set. Monday was the amazing session. Let's talk about what's happening in the car sector. Nissan shares trading a little lower today after it posted full-year net losses of $4.5 billion, its biggest annual loss since 1999. The car maker says it will close 7 factories and slash 20,000 jobs as the CEO looks to accelerate the restructuring plans. Analysts not entirely convinced. Citigroup says those plans look inadequate and don't seem to include a tariff impact. We are going to be, I think, talking to the Nissan CEO a little bit later on, so stay tuned for that interview, not on this show, but right here on Bloomberg. With that in mind, let's bring in the Renault CEO, the Renault brand CEO, Fabrice Camboulive. Nice to see you. Good
nice to meet you. Thank you.
Nice to meet you too. The car industry is caught up in so many different things right now. You've got the tariff story, you've got a technology story, you've got a drivetrain story. There's so many things that are changing within the industry. And I'm wondering how you think the industry is adapting to that process and how consumers are reacting to that process. What do you think consumers want right now? What are they looking for in a car? Because it seems like choosing a car at the moment is one of the most complicated decisions you'll ever make. It used to be really straightforward. Like, was it a diesel? Was it a petrol? How big do you want the engine to be? How fast do you want it to go? How comfortable do you want it to be? But that conversation is now much more complicated.
I mean, the consumers are like we are. It means they need visibility. Visibility on the technology, visibility on the regulation, visibility on the price. Visibility on the residual value of the car after 4 or 5 years. That's why you have and we have to make the right technological choices. If you come back 4 years ago, at the beginning of the electrification of the market in Europe, you could have chosen different ways. Should I go to hybrid? Should I go to diesel? Should I go to pure BEV electric car? It means we had to make bold choices, but also a kind of two-leg strategy. We decided on one hand for the people who want autonomy to propose on all our IC cars hybrid technology, which is allow you to have a low consumption but a very high autonomy. And for the pioneer, we decided to renew our BEV lineup on pure dedicated BEV platform. That's the way we decided to give and to open the choice to our customers.
We were joking, and we were joking earlier on in the show, and Chris is going to roll her eyes at this point, talking about the kind of the Renault 4. I can't remember the Renault 4.
I was getting nostalgic about the Renault 5.
What a car. And you said that, and you said, this is why we do this. We bring back these vehicles because there's a certain familiarity. Does that familiarity make it easier for consumers to make difficult choices when they think about what has happened? They remember these vehicles. This is just the latest iteration of this vehicle. Does that make is it sort of camouflage for what is happening, but consumers are more relaxed, therefore, with the decision?
I think if we would have decided to electrify an IC car, a normal existing IC car, it would have been a boring job.
Yeah.
When you come back to the 60s, when you come back to the 80s, and you reinterpret a car, but focus on the modernity, focus on new technology, you can, at the same time, have a blend of emotion and technology. And I think that's what we decided to do with R5 first, and look at the results. The car is a very emotional car.
Yep.
When you drive the car, you attract the sympathy of the over, which is quite unique. And that's why we decided not only to do that with R5, but to do that with R4, which is very complementary to R5 in terms of practicality, versatility, trunk roominess.
Apparently they're trying to put the gear lever in, the amazing gear lever in the Renault 4.
Yeah, we tried to do that, but unfortunately, due to safety reasons, it was very difficult to put that.
Okay, and in our conversation in the break, Fabrice, you were talking about the Madeleine de Proust, so suggesting that this triggers all kinds of nostalgic memories for consumers who remember these cars of old. Let me bring things right up to date, though, right now. President Trump in the White House. Now, obviously, the Renault brand sells little into the United States.
We are not present as a brand in the United States.
But the secondary impact on the sector in terms of supply chain issues, is that something that you are having to deal with? Is it having any impact on what you're doing?
Now, of course, we are watching that closely. But, when you go through all what happened in the last 20 years, tariffs are just part of the story, part of the equation. On top of the tariff, you have rates exchange variation, you have logistic supply chain problems, you have regulations changes. It means when you want really to be present in a country, of course, you can choose the easiest way is to export car from one country to another. But I think the best way is to localize and to produce in the country.
Yes.
We are not present in the US, but we are present in many, many different regions. In Latam, in Brazil, in Korea, in India, in Morocco, in Turkey. And in each country, we try to be very balanced between a high level of localization and the capacity to sell on the spot and to export the cars.
Yes.
I think in this context, which is quite uncertain, the risk management is more important than everything else. And for that, you need to be very balanced.
Yep. When you talk about that risk management story, and I appreciate that you're not in the U.S. as a brand, talk to us about, and Anna mentioned it from a trade perspective, I'm curious about from a kind of EV perspective as well. A good chunk of the world, even in the UK here, are pulling away from that kind of EV dominance that I think was such a big factor over the last couple of years. What is Renault doing there, especially when we're seeing European car sales, for example, in the EV space rise, but the likes of Tesla, which I would say is the kind of main name brand of an EV, drop? How does that factor into where Renault stands?
I think when the level of EV in the European market is at 17%. It means it's quite high already. I think for me there is no comeback, but there are still a lot of room for us to grow. And by the way, in the first quarter, thanks to the arrival of R5, we grow by 80%. For me, what is important is to be able to tackle each segment of the market. In UK, we began, for instance, on the C segment in a very, very competitive segment, which is a main segment in UK. But what is interesting now is that with R5 and tomorrow R4 or even Twingo, we are now targeting a new type of customer, which is a retail, on a small compact car for the cities or for the campaign. And for me, this is very interesting because this shift will enable us to catch a growth which is still, and the margin which is still huge because you tackle 30% of the market. It means, to come back to your question, the point is not to grab sales from another brand because we are all solidaire in this growth in terms of EV, which is a very bumpy road.
Yeah.
And somewhere, the other electric brands are road companions. What is important is really to shift the diesel customer to EV. And for that, we need to tackle each segment, and the B segment will be one of the key segments in Europe in the next months.
And Fabrice, we were just listening to Elon Musk just earlier this week, in fact, on tour with President Trump in the Middle East, talking about bringing Robotaxis to that region, and he's been trying, of course, in parts of the United States already. That's one area where we're seeing a lot of technology innovation. We hear stories from the Shanghai Motor Show about the amount of innovation in the cabin for drivers from the who is setting the pace, and I know the short answer will be Renault, but where are you looking for the pace to be set in terms of the technology? Where does that threat come from?
I think clearly now we are learning a lot from China. You're right, and I was in Shanghai 1 month ago, and the level of autonomy of the cars is quite impressive. But I think what we have to be smart and to use this technology to make our cars even safer in Europe. I don't think there is a lot of time before to have a pure autonomous car, but a lot of innovation can be put in our cars to increase the safety of our cars, and this is what we are aiming for Europe. But source of inspiration is clearly China. You're right.
But if you're and let's put safety to the side for a moment. But if you're trying to, and you made this comment, you're trying to switch a diesel customer to an EV customer. Isn't the core of that making it cheaper? How do you make an EV cheaper right now?
I think the first way to make cars cheaper is to reduce the development time. Look at the car before. We needed 5-6 years to develop, conceive, engineer, produce a car. With R5, it was 3.5 years. With R4, 3 years. And with Twingo, which will come in UK, 2 years or less than 2 years. It means when you reduce the time of development, you reduce the entry ticket of the car, you reduce the price. Okay. The second point for me is after that, to build EV car on dedicated platform is enabling you to get the essential of compact sizes. The interior roominess of a Scenic, which is a quite compact car of the C segment, is like a D segment car. It means you give more for less. This is also something very interesting. And the last point is when you speak about EV, you can upgrade the car during the life cycle. I think EV versus IC cars have this big advantage to be able to last more. And this is very important because you can upgrade the car, what you couldn't do in the past with an IC car.
All right. Fabrice Camboli, Renault brand CEO, joining us around the table, walking us through what Renault's plans look like, how they're thinking about the EV story, of course, how they're thinking about the tariff story as well. Let's turn our attention right back to Riyadh, where Donald Trump is still, I believe, concluding his meeting with the Syrian president, according to our White House pool there. It looks like they're setting up for a photo opportunity with MBS in Riyadh, a historic moment, concluding his first stop on his Middle East tour, marking his first foreign trip in the Middle East. Yeah, we certainly have confirmation from the White House pool that Trump's meeting with the Syrian president has ended, so perhaps making his way to this photo opportunity. We also had reports earlier on, Guy, that Erdogan, Trump, Mohammed bin Salman and the Syrian leader were holding an online meeting, so a lot of dialogue behind the scenes.
What happens tomorrow is the next big kind of piece in the puzzle. Where does Donald Trump go next, I think, is another interesting piece in the puzzle as well. Thursday, is he going to find himself in Turkey? Anyway, we will see what that story does and how it develops going forward. We will leave you these pictures from Riyadh. This is Bloomberg.